When we look at a company that has a monopoly, the story is usually, well, it's usually pretty boring.
Right. It's a defensive game.
Yeah, exactly. It's about protecting the castle. You dig a moat, you raise the drawbridge, and you just count your gold.
You're playing not to lose.
But today we're looking at a monopoly that is doing something. Something really weird. I mean, they have completely dominated a rare disease, affects maybe 90,000 people globally.
They own it.
They own it. But instead of just sitting on that massive pile of cash, they were taking this huge gamble to try and crack a code that affects hundreds of millions of people.
It's the classic big fish in a small pond deciding to jump into the ocean. And not just any ocean. We're talking shark-infested waters here.
And that is the story we are unpacking today with Vertex Pharmaceuticals, ticker VRTX. It is Friday, February 13th, 2026.
A slightly ominous date for an earnings review, isn't it?
Let's hope not for the shareholders. So we're looking at the Q4 2025 earnings that dropped about 48 hours ago. And honestly, if you just scan the headlines, it looks like a mixed bag.
It really does.
You've got a revenue beat, $3.19 billion, up 10% year over year. Looks solid. But then you look at the bottom line, the earnings per share, and it's a miss.
Yeah, the non-GAAP EPS came in at $5.03. And the street, they were expecting somewhere between $5.07 and $5.11.
So usually an EPS miss is a red flag. It means margins are getting squeezed, maybe expenses are getting sloppy. But looking at the sources you've brought, you're arguing this is actually a constructiveness.
I am.
That sounds a bit like corporate spin, doesn't it? Convince me.
It absolutely sounds like spin, but you have to look at where the money went. Vertex isn't losing money because sales are drying up or because they're being inefficient. The miss is entirely driven by a massive intentional spike in R&D and SG&A.
Selling, general, and administrative expenses.
Exactly.
Okay, so they're spending more. But on what specifically?
On the launch pad, you can't launch two potential blockbuster drugs at the same time for free. They're rolling out Alyftrek for cystic fibrosis and Juggernaut for acute pain.
Massive launches.
That means hiring armies of sales reps, funding huge marketing campaigns, building out distribution. This is what I call good spending. They are intentionally depressing earnings today to fuel an explosion in 2026.
So it's that classic crouch before the jump. Reinvesting the profits from the monopoly to buy growth in new markets.
Precisely. And the market seems to get that, mostly because of their balance sheet. You have to remember, Vertex is a financial fortress.
Right.
As of this report, they are sitting on roughly $12.3 billion in cash.
$12.3 billion in this interest rate environment.
And zero debt. Just a massive pile of cash. That isn't just a safety net, it's a strategic weapon.
Yeah.
It means they don't have to go to the bank and borrow at 6 or 7% to fund all this.
They're self-funding their own transformation.
They control their own destiny.
Okay, so let's talk about the engine that generated all that cash in the first place. The fortress, as we're calling it. Cystic fibrosis.
This is the core of the business. Vertex has effectively cured a disease that was once a death sentence for young people. They have over 90% market share.
It's a monopoly in all but name.
Absolutely.
And for years, the flagship drug, the one that really changed everything, was Trikafta. But looking at this Q4 report, Trikafta revenue is actually down 5.5%. If I'm a shareholder, do I panic? Is the fortress crumbling?
No, and this is such an important point. The fortress isn't crumbling, it's being renovated. Vertex is intentionally cannibalizing its own product.
How so?
They are aggressively moving patients off of Trikafta and onto their new drug, Alyftrek, the Vanza triple.
I see the numbers here. Alyftrek did $380 million in just one quarter. That's a fast launch.
Very fast.
But play devil's advocate for a second. If Trikafta works perfectly well, why go through the hassle of switching thousands of patients? Why rock the boat?
Two big reasons. First, it's just better for the patient. Trikafta is a twice-daily regimen. Alyftrek is once daily.
Okay.
If you have a chronic illness, cutting your pill burden in half is a massive quality-of-life improvement. It improves adherence, which means patients stay healthier.
Sure, that makes sense.
But the science is better, too. We look at something called sweat chloride levels. In CF, salt doesn't move through cells correctly, so patients have very salty sweat. The lower the sweat chloride, the better the drug is working.
And Alyftrek is better on that front.
The clinical data shows it lowers those levels by an additional 10 millimol compared to Trikafta. It's just objectively a better drug.
It is.
It is. But, and here is the nugget that our deep dive listeners really need to grasp. There is a financial magic trick happening here.
I was waiting for this. Break down the royalty loophole.
Okay, so Trikafta was developed using technology that Vertex licensed from the Cystic Fibrosis Foundation years ago. Because of that agreement, Vertex pays a royalty on every single pill they sell.
And that royalty is what?
It's about 9%.
Wow. That's a steep tax. Almost 10% of revenue right off the top, just gone.
Exactly. But Alyftrek, that's built on Vertex's own proprietary tech. They developed it in-house.
So the royalty obligation?
It drops dramatically. We're talking low single digits. The estimates are around 1 to 3%.
Wait, let me make sure I've got this straight. They move a patient from drug A to drug B. They charge roughly the same price. But simply by switching the pill, Vertex keeps an extra, 6 to 8% of pure profit?
You got it. It's a massive margin expansion story hidden in plain sight. Even if they don't add a single new patient, their bottom line grows just by switching everyone over.
That is brilliant.
It's brilliant corporate strategy. They're optimizing the monopoly.
But we have to address the elephant in the room. Cystic fibrosis is a rare disease. There's a ceiling. 90,000 patients globally. You can't grow that market forever.
And that brings us to the jump. This is why 2026 is such a pivotal year. They are trying to leap from a market of 90,000 to a market of 80 million.
The pain market.
The acute pain market. This is the launch of Juggernaut.
Formerly VX548. This got FDA approval back in January 2025. Now, whenever I hear painkiller, I immediately think opioid. And we all know the history there.
Right. It's fraught with liability, addiction, danger.
So how is this actually different?
It's completely different biology. Think of your nervous system like the wiring in your house. When you're in pain, it's like a specific light switch has been flipped on, sending a signal to your brain saying hurt.
Okay, I'm with you.
Opioids work by basically cutting the power to the whole house. They shut down the brain's perception of pain, but they also depress breathing, affect alertness, and crucially, they rewire the brain's reward system.
The sledgehammer approach.
It is. It works, but the collateral damage is just too high.
So Juggernaut is?
It's a precision tool. It targets a very specific sodium channel called Navi 1.8. This channel is like a little gatekeeper on your peripheral nerves, the ones in your arms, legs, body. GeneVex basically just locks that gate.
It stops the pain signal at the source.
At the source. Before it ever gets to the brain's chemical reward system, it's peripheral, not central.
That sounds like the holy grail. But we've heard promises like this before in biotech. The real question is it selling? We're looking at these Q4 2025 numbers. How did it do?
Well, in 2025, they did about 550,000 prescriptions. That brought in roughly $60 million in revenue.
$60 million. For a company doing over $3 billion a quarter, that feels underwhelming. If this is the future of the company, shouldn't it be exploding out of the gate?
It's a slow burn, and that was expected. You have to remember, you're fighting against 50 years of habit. Surgeons have been prescribing Vicodin and Percocet for decades.
They're cheap. They're generic.
And they work well enough. Convincing a doctor to fight with an insurance company to prescribe a new branded drug, it takes time.
So it's a friction problem. The product is good, but the system is just stuck in its ways.
Exactly. But look at the guidance for 2026. Management is aiming to triple that number. They want over 1.5 million prescriptions this year.
Oh, just by hoping doctors get smarter.
No, brute force. They are doubling their sales force in Q2. They are putting boots on the ground in every major hospital.
What about the insurance side?
That's the real win. On the back end, they've cracked the insurance code. They have secured coverage with major PBMs, the pharmacy benefit managers, that cover 200 million lives.
And that's the key unlock, isn't it? If the doctor knows the patient won't get hit with a surprise $500 bill at the pharmacy, they're way more likely to write the script.
That's it. The goal is to make Juggernaut the standard of care for things like, wisdom teeth removal, knee replacements, C-sections. They want to replace opioids in that post-surgery recovery window.
It's a massive ambition. But Vertex isn't stopping there. We have to talk about the rest of the pipeline because there's some real sci-fi stuff happening here. Gene editing.
Yeah, this is Casgevy. It's the world's first CRISPR therapy for sickle cell and beta thalassemia.
Science fiction becoming reality. But looking at the financials, $116 million in revenue for 2025. Again, for a functional cure, shouldn't that be higher?
You have to look at the logistics. This is not a pill you pick up at CVS. They have to harvest your stem cells, ship them to a lab, edit the DNA, ship them back, and then reinfuse them. The whole process takes months, so the revenue recognition it's lumpy. It's a very complex service.
But the leading indicator?
The leading indicator is strong. They had 111 new patient starts in Q4. That's a backlog of revenue that will hit the books later in 2026 and 2027. It's building momentum, just slowly.
Okay, so that's the slow burn. But you flagged something in the research as a hidden gem, a kidney drug with a name I am absolutely going to butcher.
Povetacicept.
Bless you.
Let's just call it POVA. This is for a disease called IgA nephropathy. Essentially, a specific protein just clumps up in your kidneys and destroys the filters over time. It leads to kidney failure.
And how does POVA fix it?
It inhibits two proteins, BAF and APRIL, that fuel the disease. And the data we've seen so far is startling. It shows a 64% reduction in proteinuria.
Break that down for me. Proteinuria is protein in the urine, right?
Yeah.
Right. Your kidneys are filters. If protein is leaking into your urine, it means the filter is full of holes. Reducing that leakage by 64% is a massive signal that the kidney is healing. That number absolutely crushes the competition.
And is this another complex hospital procedure?
No, and that's the beauty of it. It's a once-monthly self-injection. The competitors are often complicated infusions or, daily pills with nasty side effects.
So better efficacy, better convenience. It's the same playbook as cystic fibrosis with Alyftrek.
Exactly the same playbook. Phase 3 interim data is due in the first half of this year. If that looks good, this becomes a massive revenue driver by 2027. It's the sleeper hit of the portfolio.
So we've got the Fortress of CF, the pain launch, the kidney gem.
Yeah.
And then there's the moonshot. Type 1 diabetes.
This is the one that, it gives me chills.
Well, we aren't talking about better insulin pumps here, are we?
No. We are talking about a functional cure. In type 1 diabetes, the body attacks its own islet cells in the pancreas, so you just can't produce insulin. Vertex is working on replacing those cells.
But haven't people tried transplants before? I feel like I've read about this.
They have, but usually you need a donor pancreas, which is incredibly rare, or you use the patient's own cells, which is really complicated. Vertex is doing something different. They are using stem cell-derived, fully differentiated islet cells.
English, please.
They are factory making the cells. They are manufacturing human islet cells on a production line. It's off the shelf.
Yeah.
They have patients in trials right now who have come off insulin entirely.
That is just mind-blowing. Imagine telling a type 1 diabetic they might simply not be diabetic anymore. No more monitoring, no more injections.
And here's the investor angle. This is currently priced at roughly zero in the stock.
Really?
The market is so skeptical because this has been the impossible problem for decades. So if they succeed, it represents massive, massive upside. It's a free lottery ticket attached to the stock.
So let's bring it back to the dollars and cents. We've covered the medicine. Let's look at the valuation. What's the 2026 guidance look like?
They're projecting revenue between $12.95 billion and $13.1 billion.
Big numbers.
Big numbers. But the most critical number inside that guidance isn't the total. It's this. They have explicitly targeted over $500 million in revenue from non-CF products in 2026.
Why is that $500 million mark so specific? Why do they care where the money comes from?
It's the proof of concept. For years, critics have said Vertex is a one-trick pony. They say, sure, they own CF, but they can't do anything else.
Wow.
If they hit $500 million from pain and Casgevy, they prove the thesis. They prove they can diversify.
It changes the entire narrative from specialty pharma to what?
To mega healthcare growth.
Yeah.
Think Eli Lilly or Novo Nordisk. Right now, Vertex trades at a much lower multiple than those guys because of that one-trick fear. If that fear evaporates, the stock re-rates.
And analysts are talking about price targets over $600 a share compared to the roughly $491 it's trading at today.
Right. The whole bull case is that the miss in earnings today, that spending on R&D and sales reps, is just the cost of buying that ticket to the big leagues.
Okay, we've been pretty bullish here. We have to be responsible. What kills this thesis? What keeps the CEO up at night?
Execution risk. 2026 is expensive. If they spend all this money on sales reps and the pain drug doesn't take off, then that good spending starts to look like bad burning.
And doctors are stubborn.
Incredibly stubborn. Changing prescribing habits is the hardest thing to do in pharma. If the adoption curve for Juggernaut is flatter than they expect, the stock will get punished.
And politics.
Always a threat. Drug pricing is a constant target. Vertex says their supply chains are safe from tariffs, which is good, but government negotiation on pricing is always looming, especially for a high-volume drug like a painkiller.
Fair enough. But stepping back, looking at the big picture, it's a fascinating moment. You have a company using a monopoly in one disease to bankroll the cure for 3 others.
It's the ideal business model for biotech. Use the cash cow to fund the moonshots.
As we wrap up, I want to leave you with one final thought. We talked a lot about EPS and margins, but think about that pain market again. For 50 years, our society has accepted opioids as a necessary evil.
It's true.
We just accepted that a certain percentage of people getting knee surgery would end up addicted. It was the cost of doing business for medicine.
A terrible cost, both human and economic.
If Vertex pulls this off, if Juggernaut actually works and gets adopted, they aren't just making money. They are effectively deleting an entire category of addiction risk from the medical system.
It's a complete paradigm shift.
It makes you wonder, is the market underestimating the value of simply not destroying lives? We pay billions to fix addiction. What is it worth to prevent it entirely?
That is the multi-billion-dollar question.
Something to chew on over the weekend. Thanks for listening to The Deep Dive. We'll see you next time.